Today we are going to go over the itemized deductions, which is the Schedule A. And as you see this Schedule 1040 form, if you're looking at the left-hand side, there is a couple of items and sections that you need to file with the Schedule A, which is the reduce the taxable income items. These Schedule A items are very important for your examination, and at least one questions for each of these items are going to see in the exam. So you have to know every little detail, and next couple of classes we are going to go over these details, but for today's class it's going to be go over for more of the itemized deductions regarding the general instruction. For itemized deductions, it is itemizing your tax deductions involve claiming a whole group of allowable paid expenses on a separate tax form, which we just saw in the Schedule A. And that's submitted with the your form with 1040. Available itemized deductions range from medical expenses to charitable gifts to mortgage interest and even state and local taxes. We're going to go these details later on. That we are going to use a study for each detail for next few classes. And both the standard deduction and the total of your itemized deductions reduce the amount of income on which you must pay federal income tax. You can claim either the standard deduction, or you can itemize your qualified individual deductions line by line, but you can do not both. We already studied for this standard deduction as a flat rate in the previous class, and then you can review for the standard deduction class. It only makes sense to choose either one of these standard deduction or itemized deduction to take the most of your taxable income. So you have to consider whether you are going to take the standard deduction, which reduce more of your taxable income, then you have to choose the standard deduction. But if itemized deduction gives you more benefit to report tax, then you have to select the itemized deduction. Then the what is the itemized means that itemizing is just what it sounds like, the reporting your actual expenses for various types of allowable deductions, then adding them all together and then entering the total dollar amount on your tax returns. We studied this standard deduction in previous class. Then what should be difference between the itemized deduction versus and standard deduction? The standard deduction is easy way out, and it's a set amount based on your filing status, which is determined by your personal situation, such as whether you are single or married and whether you have any dependents. Because it's much simpler and then easy to file with the standard deduction, most taxpayers have historically claimed the standard deduction. And the number of, most likely increase even more because of the Tax Cut and Job Act also make tweaks to some itemized deductions, capping them at certain amounts where they were unlimited before. Other itemized deductions were eliminated entirely after this Tax and Job Cut Act. It's to a taxpayer's advantage to itemize when the total of all their individual deductions exceeds the standard deduction for their filing status. Otherwise, it would make no sense. They would be paying taxes on more income than they would have to. So for example, a single filer would be better off itemizing if they had a total itemized deductions of $13,000 in current tax year. This would take an additional $800 off their taxable income because the standard deduction is $12,200. But the same filer would end up paying taxes on additional 5,350 if they itemize and they instead qualified as head of household. The difference between 13,000 in itemized deductions and the 18,350 standard deduction, they would be entitled to claim for this filing status. Then what expenses can be itemized? As you see here, you can claim itemized deductions in these following categories, which is the medical and dental expenses, state and local income taxes, and real estate taxes. We all together, it's all taxes. And then also interest expense, but specifically in Schedule A, it refers to the home mortgage interest. And then also that includes mortgage insurance premiums, and also gifts to charity, which is the charitable contribution donation, and then also casualty and theft losses. The IRS offers a list of all available and updated itemized deductions on its website each year. So you can refer for any more detailed level going to IRS website. And here is the list of some qualifying deductions, and it's fairly extensive, but limitation apply to some of them, and we will go over briefly. So first, for medical expense deduction will be medical and also dental expenses include the cost of insurance premium, as long as your employer doesn't reimburse you for them, and as well as a certain qualifying medical and dental expenses. And you can deduct the portion that exceed, you have to be exceed amount of 7.5% of your AGI. And this means if your AGI is, let's say, 5,500 and you had 7,500 qualifying medical expenses, and your deduction would be limited to 3,375. That amount exceeds 4,125 or 7.5% of your AGI. We are going to detail on this later on, but the 7.5% of your AGI, that amounts exceeds the deduction for medical and dental expenses. So you have to remember some of the itemized deduction is up to that amount, but this medical and the dental expenses, the cost or expenses you could deduct is exceeding for AGI amount. And also for state and local tax deductions, that Tax Cut and Job Act restrict the deductions for state, local, and property taxes to 10,000 beginning 2018, or 5,000 if you are married and filing separate returns. And this is about 10,000 collectively, not 10,000 for each type of tax. So every tax you adding up together, and then 10,000, up to 10,000 you can deduct for this taxes. And also for mortgage interest deduction, the mortgage interest deduction is capped that's of 750,000 by the Tax Cut and Job Act, and down from 1 million in 2017, but now it went back to 715 to 1 million. We are going to go more detailed later on, but limit is the 375 for taxpayer who are married and the file separate returns. The Tax Cut and Job Act additionally restrict this deduction to acquisition debt only, not equity debt, as has historically been the case, unless the funds from the equity loan are used to buy, build, or substantially improve a home, according to the IRS. And also gift to charities. The IRS supports generosity And the Tax Cut and Job Act also changed this itemized deduction effective 2018. It used to be limited to overall gift totaling no more than 50% of the taxpayer's AGI. That's gone up to 60% in the many cases, but some types of gift are still subject to 20, 30, and 50 limits that detail will go on to later class. And also casualty and theft losses. The Tax Cut and Job Act limits the casualty and theft loss deduction to losses sustained due to events that occurred in locations that have been declared to be disaster area by the U.S. President. On the bright side, itemized deductions were limited through tax year 2017 when the taxpayer's AGI exceeded certain limits. So we had a phase-out limits for each single or married filing or head of household. Every filing status has different phase-out limits. But these threshold were we called peace limits after Representative Donald Peace, who first authorized the legislation that provided for them back in 1990. The total amount of the itemized deductions you could claim used to be reduced by 3% of the amount by which your AGI exceeded that year's threshold up to 80% of your total itemized deductions. But this is no longer the case. So the Tax Cut and Job Act has repealed peace limitations to the at least 2025 when the law sunsets or expires unless Congress acts to renew. So at least you need to have general idea about the itemized deduction filing for Schedule A with Form 1040.